Thank you very much. It's a pleasure to be here. Today I want to talk about the economics of funding agricultural research. I think we're at a very important time in Canada right now where, one, there's a recognition that in fact there isn't enough research going into some components such as cereal research, but also very much a changing structure for how research is being funded. And I want to address that issue today. I'm first going to begin by talking about some evidence on the producer returns to research, not only some global studies, but also studies done here. And then I'm going to talk about, build on Jeff's presentation somewhat, talking about public producer-private partnerships for funding. I'll talk about the Australian research system and how it is funded, with a little bit of mention of what's happened in the UK, and then maybe discuss what some of the options are for funding wheat research in Canada. In terms of the producer returns to research, I think the producers here are certainly well aware of it. You get higher yields, lower costs, better quality, better disease management, etc. You've also got, as well, public benefits that go beyond the farm gate: improved environment, improved human health, improved food security. If we look at who funds research, we actually see three different groups that are involved in funding research. We have governments representing the taxpayers, funded through the taxpayers. We have producers and consumers through checkoffs, and producers through seed and other inputs. The reason I mention consumers in checkoffs is there's an understanding that if a producer delivers grain and they pay a checkoff, that in fact that's paid by the producer, but it actually creates a wedge between what the producer gets and what the grain buyer has to pay for the product. It's very much like GST or other products, which actually is shared in cost between the firm selling it or the individual selling it and those buying it. One of the more difficult things about evaluating the returns to research is that research is not something that happens instantly. You have to invest many years often in research before you realize benefits. So you have this red area on the graph represents research costs, which are actually the cost of doing the research itself, and then many years later the research benefits start to be realized. On this diagram you've got benefits starting 7 years later. More recent study looking at the US, in their system, they found that the peak impact of $1 worth of agricultural research actually happens 25 years later. Very long lag. So it's more than just research. It's more than just the next variety. It's the varieties that build on that. If you think about the canola industry, yeah, we had canola by the early 70s, but in fact the industry really took off after that. So it takes a long time to build industries and to see the real long returns, and we have to keep that in mind. So when I'm talking about the benefits and costs research, keep in mind that in fact these are spread over time, and that when we measure the returns to research, we actually take this into account, that time is money. And we recognize that getting $1 today is worth more than getting the same dollar a few years from now. And in all of these studies, we basically use a discount rate of about 5% per year, which means that we assume that money costs 5% per year when it's an investment in these studies. We often use a benefit-cost ratio to measure the benefits of research, which basically looks at the stream of benefits that are going to occur over time, usually into the future, and compare that to the costs that were invested in the past. And once we do the discounting, we basically make those costs in the past worth more and those benefits in the future worth less, if you like. And a benefit-cost ratio equal to 1, it means that the present value of those costs is equal to the present value of the benefits, and anything above 1 is a good return. A benefit-cost ratio of 2 to 1 is actually a good investment. It assumes you're getting twice the benefits back than what you put in, even after you've taken into account discounting. The other thing we look at when we measure rates of return is called the internal rate of return, and that's the rate of return that a dollar invested is earning in the investment. It's like if you're getting a 5% return on a research investment, it's like getting a 5% return in a bank account. 10% is a great rate of return. Even 5% would be good in a savings account these days. 10% would be great. 20% is fantastic. If you look now, just turning to some studies that have been done in the world, this is probably the largest study that was ever done. They gathered up 292 separate studies and put them all together, came up with 1,800 different research investments that had been made, and they looked at what's the internal rate of return across these studies, and as represented by the yellow bars there. The most common rate of return was 30% a year. 30% internal rate of return across 1,800 different observations, and the mean of that study was actually 82% a year. Very, very high rates of return, and these were done basically on public research expenditures all over the world prior to 2000. Again, I'll show you some Canadian numbers later. There's some new evidence in this book called Persistence Pays that came out in January 2010. Basically, it looked at investments in U.S. agricultural research at the state level and the federal level, going back to starting in 1850 up until today, and then looked at how productivity had improved in each of those states. They found a benefit-cost ratio, this time comparing the ratio of benefits to cost, to be for state-level research, there was 21 times the benefits coming out that what was put in costs, even after the discounting. And the second number, the 32.1, research is done within a state, spills well beyond the borders of the state. It spreads over to all of the USA, if you like. And if you take those benefits into account, it's actually a 32-to-1 benefit-cost ratio. USDA research was 17.5-to-1. Again, the benefit-cost ratio, anyone over 1 is great, but 17-to-1 is $17 back for every dollar you put in, even after the discounting. I'm going to talk about some Canadian returns to research. Some of these are fairly recent. This one was done in 2012, just completed it about a month ago. We looked at the benefit-cost ratio of investments in cereal research done by WGRF. We found the benefit-cost ratio to be 20.4-to-1 for wheat research. That's for all types of wheat. 7.5-to-1 for barley. And I've got to say that with barley varieties don't change very often, so we might be on the thresholds of another big change. So it's not very reliable over time. But we've still a benefit-cost ratio of even 7.5-to-1 is still a very big number. It means you're getting 7 times out what you're getting 7.5 times the dollars back over what was invested, even taking discounting into account. The internal rate of return is 36% a year per wheat. It's like getting those checkoff dollars, if you like, have earned you 36% a year, if you like, in that investment. So it's certainly been a good investment. And the barley dollar is 28%. Second study, which I was involved in a year ago, we looked at the returns to zero tillage research. I think for most of the producers in here, you understand the impact that's had on your farms and how it's reduced labor and fuel requirements and impacted on yields and other benefits. We found basically a 52-to-1 benefit-cost ratio for zero tillage research. That's the public on the public side. Very high rates of return involved in that. The machinery sector has also done very well with zero tillage. They've earned about they've generated $121 in sales for every $1 they've invested in research. So combined, it's certainly an impressive set of technology and a success story. Just completed a master's student defended this fall. It's yet to be written up into a nice, friendly report, if you like. We looked at the benefits of the regional variety trials. Basically, the way it works is that producers use yield indexes and other characteristics that show up in the variety trials to make their cropping decisions, and you're choosing varieties. So the fact that that information is there means that producers are growing the better, choosing the higher yielding varieties sooner. They're adopting them quicker. So we looked at how producers had responded to that information in the past, and then we said, what would happen is if there was no regional variety trials and producers were more or less guessing at which variety was going to be better than the other. And we showed these benefits here per year, and we came up with a 63-to-1 benefit cost ratio. They don't cost very much, but from a producer's perspective, knowing what varieties to grow is pretty important. And for a lot of producers to try and figure that out on your farm would be something, if you could ever do it, would take a long time. Another success story, again, is the Saskatchewan pulse growers. This was study is based on pulse growers were formed in 1984. We did this study in 2008, looking at the research investments they had. We did spin the benefits out to 2024, but those were only the benefits on the varieties that had already been commercialized. We weren't making up new varieties in that stream. It was the varieties that had already hit the stream, if you like. We had benefit cost ratios of 27.8 to 1 for the genetics part, 15.7 to 1 for the development acceleration. What we mean by development acceleration is the pulse growers were obviously involved in more than just genetic research. They were involved in the development of inoculants and land rollers and agronomic research that actually helped promote that crop. And rather than assuming that the pulse growers are responsible for the development of the industry, we said that it accelerated that development of the industry by 2 years. The industry developed 2 years sooner than it would have been otherwise, and even that is a huge benefit if you take it into account, and it produced a benefit cost ratio of 15.7 to 1 for producers. Internal rates of return are both about 40% a year. Again, very impressive rates of return. So even recent work in Canada shows very, very high rates of return to investments in research. That's the good news. The bad news is that the high benefit cost ratios suggest we're not spending nearly enough, not as governments, not as producers, in order to capture these benefits. Research is a tool that can increase economic growth and certainly can address food security at the same time. As I mentioned earlier, we're at a critical time in agricultural research in Canada. Agriculture Canada, we heard some of the discussion today, although they're committed to do research in the long run, they're going to change the commercialization of wheat research. Which company, whether it's public or private, is going to commercialize wheat varieties may change in the future. And we've talked about new funding models in Alberta. Here you have a new wheat commission. There's probably going to be one to follow in Manitoba and Alberta. The WJRF has a 4-year life. Is it going to get a new life after that? So there's a lot of things at play right now in terms of going forward. And as an industry, it's really important that we decide how to actually go forward in a way that's going to provide more research funding. If we fail on that objective, the benefit cost ratios will stay really high, but we just won't be putting enough in the investment side to actually realize the potential benefits on the other side. By the way, I am encouraged with the Alberta Wheat Commission basically providing an additional 70 cents per ton checkoff. The 30 cents per ton checkoff works out to $12 per B train right on a truck. It's not very much. And even at $1, that's $40 per truckload. If you think about what 1% higher yield would mean on your farm, you could pay that $40 a lot of times for a truckload. So it's useful to think about that. The first thing I think when evaluating other research systems is to look at basically how much investment is being generated, because it's the investments that actually are going to generate the returns. We know that the benefit-cost ratio is high once the dollars are invested. I've got 4 models here. The first one's wheat in Australia. It has a research intensity ratio of over 2%, meaning about 2% of gross sales gets reinvested in research. The next one, the little bar you can hardly see, that's wheat in Canada. We're at less than half of 1% of our gross sales. It's a $5 billion industry. And, you know, we're not putting much investment in there. Less than 0.5% of gross sales. By any standards, that's a low amount. For canola and corn, don't look at the white bars. The white bar includes what the private companies collect as rents. The green bar is what they actually invest in research. Okay, so you have to go from the green bar down. So canola has almost a 2% research intensity. So yes, they're investing a lot more than they are in wheat, about 4 times the amount, but it's still under 2% and less than what the Australians are investing in their wheat research industry. Corn in the U.S., the same thing. Producers have to pay a lot, which makes up the white bar. That's what they pay for the technology through seed, but the green bar is what is actually getting invested. So it isn't all that intensive as you go to these private research industries. The final thing I'd point out is that canola and corn are hybrids. Yes, they're different in terms of, it's more recent crop in terms of case of canola and et cetera. But hybrid allows private companies to actually capture returns every time the crop is growing. Producers have to pay for that, and then they invest about 10% of what they take in revenue back into research. Basically how that industry works. But that cannot happen unless there's property rights that allow the firms to actually capture those returns in the first place. They're not going to do it with ordinary plant breeders' rights. There's just isn't enough tools for them to capture the income in the first place. This is some yield comparisons across crops, and I'm fully, I know I've got a lot of people here that will question this, but the red line is the increase in wheat yields over time. They're yielding now about 25% more than what they did in 1960, just in terms of genetic advancement. The green line is pulses. They've gone up much more rapidly. But again, a lot of that work was just adapting those varieties to here. So they were easy gains, if you like, low-hanging fruit. And canola, is the black line on the top. It took off considerably between between about 2000 and 2006, once the hybrids had kicked in. I would question, though, whether that line has continued that trend. If you take 5440, came out in 2005, and my understanding is it's still a pretty competitive variety. So we haven't seen a 20% yield increase since 2005, I don't think. I think it's leveled out. So maybe some of those easier gains are gone. But the bottom line is canola has increased in yield a lot more because it's had, one of the explanations is had 4 times the amount of research going into it, which makes a difference. Going forward then, if we're looking for models to fund research, we have 3 different forms of funding. We have private firms, producer or industry funding, and public research. And each one has a specific role. Public goods, first of all, and I've got under that little term underneath, non-excludable. They're producing goods that you can't exclude others from using once you've created an idea or knowledge. You can't exclude people from using it, so you can't charge people to use it. So if it's an idea that you can't charge for, it's something that the public can produce and belongs under what category of a public good. And there's 2 types of public goods, really. There's the public goods that are widely dispersed amongst the population, the taxpayers, if you like. And then there are those goods that are quite specific to particular sets of growers and consumers. Those are industry goods. Okay, they're both. So this first category I'm going to call public goods is ideally suited by government, and that includes basic scientific research, things like science literacy, ecology, chemistry, biology, even ideas like business management. If there's a really good way to manage your business, you can't really, those ideas are very difficult to exclude and apply very widely in an economy. Human genomics would be another one. Pathogen research would be another one. The next group are industry goods, and those are non-excludable goods, but where most of the gains go to people in the industry, in this case, the grains industry. That would include crop genomics, germplasm, unprotected varieties. Everybody in the industry benefits from those. And they differ from the public goods because they're limited more, the benefits are more concentrated within an industry. Okay? Agronomics, best management practices, knowledge dissemination or extension, product input testing, crop disease research, quality standards, those are industry types goods that are more naturally funded by industry. And then there's private goods. Private goods can only fund goods that are excludable. If there's not a mechanism to capture value, they will not make the investments. So you have intellectually protected crop varieties and traits and processes, protected production processes, patented mechanical innovations, chemical pesticides, inoculants, again, it can be patented, and private brand name product and market development. So there's three types of goods here, and if you think about it, basically there's three forms of funding that naturally fit. The governments are the natural to provide the public goods. The industry, they're most naturally suited to provide those industry goods because they're the ones that are going to capture most of the benefits from those goods. And then the private goods, once the property rates are in place, can be provided by the private sector. I would argue that these are not substitutes for one another, and that the best models is basically private producer public partnerships. And they used to call a public-private as a 3P model, public-private partnership as 3P. So once you add producer, it becomes 4P. I apologize for that, but that's how they count in the literature. So in this, I think it's important to have all three groups because balance is required. First of all, if we're talking about doing more research, the more groups there are that can fund the research, the more research that gets done and the more benefits that are created overall. And second, if you don't have the public, there's nobody that has the incentive to produce that. If you don't have the industry or the producers there, there's not a strong incentive to produce those non-excludable industry goods. And certainly you need the private goods, I would argue, in part to tap into the intellectual property that these large multinational firms now have in biotechnology and other things. If you leave them outside your industry entirely, you're going to lose some very important technologies over time. And I think they're required to bring in that technology, but I would argue within a partnership rather than an exclusive type of an arrangement. Going forward, looking at these approaches, again, there's discussion that Agriculture Canada is going to basically get out of commercializing wheat varieties and move into partnerships with private and other firms. I spent 2 weeks in the UK. I did 16 interviews, and I interviewed everybody that a colleague and I interviewed, basically the leaders in the industry over that period of time. We found something quite interesting. In the UK, the Thatcher government sold the Plant Breeding Institute of Cambridge for $100 million to Unilever. That was their flagship breeding program. It would be like selling Ag Canada's breeding stations. Basically, they sold the whole works to Unilever, Unilever sold it to Monsanto. Monsanto sold it to KWS. They've now ended up with quite a small research industry. It generates about $27 million a year in royalties for all 6 firms in there. About 30% of that gets reinvested. So they have 6 programs. The largest program is $2 million a year investing in breeding. Those are tiny breeding programs, and they're acting more or less independently. To give you some idea about the 27 million, canola's about 600 million in Canada. Okay, so there's not much income going into that industry. And so that's one issue, is there's not enough, the property rights are not strong enough for the companies to get the revenue that they need to make the investments. So you've got a small industry that's replaced a very effective public breeding program. The second thing that happened in the UK, which is a lesson to learn, is that as soon as the public was not involved in the commercialization of varieties, they lost touch and lost interest in doing wheat research. They went and chased journal articles and publications in order to secure future research funding. The government said, we want quality science, we're going to look at where you publish and what important results you have. And the public scientists went off and studied a crop called Arabidopsis, quit doing wheat research, and you left these 6 small private breeding companies trying to run a breeding program with no connection with the private researchers. And people in that system said they lost 15 years, just gone in terms of advancement. So in the UK, the idea of just get out of the way and the private sector will move in and do it didn't work because their property rights weren't strong enough, and 2, there was no reason for the public scientists to actually continue to work with them. Since then, they've improved it a little bit. They've got some programs to make the public scientists now work with these breeding systems, these private companies, but it's still a small sector, and there was this 15-year gap that's gone. Australia, I would argue, has the best wheat research funding program in the world. They created something called research development corporations that were funded by a 1% levy or checkoff, non-refundable checkoff. 1%, by the way, at $200 wheat is $2 a ton. Okay, and that was matched 0.5% by government, and they did that in 1988. They have currently about a little over $100 million a year in revenue, this corporation, and that compares to our total expenditures of 20. Okay, and they have been very active in how that sector has evolved. They've continued. There's been continued support by governments or private research. And the other thing they have is they now have 3 private breeding firms. And each one of those firms has a private shareholder company, the GRDC, which is producer-run, and public shareholders, which are sort of state or university partners. There's 3 of them. There's Australian Grain Technologies. For example, its shareholders are GRDC, Southern Australian Research, which is the state of Southern Australia, Limagrain, and the University of Adelaide. So there's a number of private partners in there. They have Intergrain. It's got Monsanto as a partner, plus the Department of Western Australia and GRDC and the HRZ wheats. So you've got 3 companies that are actually these 4P models that we're talking about, and they get their revenue from Endpoint Royalties, which is the other part of the funding equation. And Endpoint Royalties are a royalty that are paid on the sale of harvested grain. When you grow a particular variety in the U.S., you're obligated to pay the Endpoint royalty on that variety. The nice part about that is it does reduce producer risk. If you don't grow a crop, you don't pay much royalty. You grow a big crop, or you pay a lot more royalty. The second advantage is that these property rights are very much complete. Every time a producer grows your variety, you're entitled to some royalties and you get some royalties. And they've created a very effective collection system that's low cost to make that work. Unlike in Canada, you pay for a variety once, but then you might be able to use it 10 times. That's good for the producer, but it isn't very good for the breeder that actually is making those investments. In Australia, they have a way of getting some of that benefit back every year. It took a while for this system in Australia to kick in because the new varieties were competing with free public varieties that were already there. Currently, they've got enough revenue to support for those three partnership companies plus one more. They can fund that now out of these endpoint royalties. But the trajectory on these endpoint royalties is impressive, and they're going to generate a lot more money in the near future in the U.S. that we invested. I would argue that the fact that you have producers and public shareholders, most of those dollars they generate will get reinvested in research as well. These are the endpoint royalties on varieties by year of release. You can see back, the first ones came about in 1999. They were about $1 a ton. The recent ones are about $3.50 a ton. So if you grow one of these varieties with a $3.50 a ton endpoint royalties, when you deliver that, you pay $3.50 a ton royalty back to the variety owner. That sounds like a lot, but if you think about 1 ton per acre, that's $3.50 an acre. It's still pretty cheap relative to canola, right? If we look at this slide, same slide again, slightly different colors. You've got this wheat in Australia. Again, ignore the white. They're reinvesting about half of that. So you've got a strong government commitment because of the matching. They've got levies, and they've got endpoint royalties. You've got wheat in Canada that you can hardly see. You've got canola, corn, and you've got wheat in the UK. Again, only the bottom half of that bar counts. The top half is basically what the private companies are keeping for their shareholders. Okay? So there's different levels of funding. So in terms of options for Canada, I would argue that there's 2 main components that we need to actually make the research investments so we can capture those 20-to-1 benefit cost ratios. If we're not making the research benefit investments, we can't capture the returns. I would argue the government should work with industry to pass legislation that create a 1% levy on wheat. A 1% levy would basically generate $60 million a year, $50 to $60 million a year. It's a lot of money relative to the $20 million we currently have. Second, it would, by creating this, it creates really strong incentive for both public and private firms to create the best varieties out there. And we've talked about Canada being compliant with, UPOV is the plant breeders' right, international plant breeders' right framework, and Canada agreed that they would put in stronger property rights in 1991, and we've never done it. This would actually do that for us finally, 25 years later. But the more important thing is it would generate some revenue that could be then controlled. The second would be to create a national, producer-controlled, non-refundable, check-off-funded research corporations. And the reason I say non-refundable, I would argue that the refundability of levies really maybe does make research organizations accountable to their members, but that would be like trying to fund a sports team where people can get their money back after the game each time. That in fact, you can only charge so much before the incentive just to apply to get your money back dominates any benefits that the whole industry is getting, because you can actually free ride on that. I would argue that accountability if you create a corporate structure, you can enhance the accountability through the share structure. You've got shareholders at that point. And the checkoffs could actually be a way of actually issuing those shares. These corporations would be similar to what they have in Australia, and they could undertake applied R&D and extension, all those industry goods we talked about before, and this is really important. And I would argue that this same corporations could be very important in being partners with private industry that you could bring to Canada. You would actually have, if you like, producer-controlled ownership of a stream of income that could make the investments, and then they can actually lead the partnerships, just like the GRDC did as well. And the third part of this, of course, is that governments need to continue their support for basic and applied research. So I'll wrap it up now. I'll certainly look forward to some questions and discussion if any of you have any energy left at all. The high rates of return to research indicate there's very significant lost opportunities to do more research. Uniform endpoint royalties would provide an immediate income stream. If we just passed legislation, took the Australians 15 years before they generated much money, it'll take 15 years here as well. Second, these non-refundable producer checkoff corporations can provide these needed industry goods. You're not relying on the secretary in downtown Toronto to pay taxes so that you can do your research. It would actually be producer-controlled research. Third, public research can then focus more on public goods if you've got this producer checkoff in the middle. The system works best through 4P partnerships, and I guess that the most important point here is that widespread engagement and planning is required. If we just think that the new research system is going to evolve quickly without a lot of engagement and planning, I think we're wrong. I think it's important. If Ag Canada wants to change, they need to know what they're changing into. And if the producer organizations, the checkoffs are going to actually engage, they need to be part of a longer, bigger strategy. And I think developing a plan and a strategy is really important to address these needs. So with that, I'll wrap it up. Thanks.